Welcome to Shooting It Straight with Stan. I'm Stan, the Annuity Man, America's annuity agent. Glad you joined me for this topic. It is a hot one. Everyone's asking me this, so I thought I'd do a video on it to cover it. And you're obviously welcome to schedule a call with me if you want to dig in deeper. But it's interest rates and annuities in 2022. What's going to happen? What's out there, Stan? What do you see happening? Well, um, let's just talk broad base for a second. The government has printed 25% more money than they had 2 years ago. So, this is a great inflationary model that you can look at. And people always say, well, they have to raise rates then, right? Well, in a perfect world, yes. If the Fed is independent like they should be and not being bullied by administrations, then there should be some raising of rates. Now, the Fed has announced that they're going to raise rates as much as 4% this year, 4 times this year, and three times next year. So that's 7 total. And I just did a podcast that's going to be out in a couple of weeks with Owen Schrum, and Owen is one of the best money managers in the country, and he was talking to people like Byron Ween and Jeffrey Siegel of Wharton, and they all believe there's going to be 7 interest rate hikes, which is a lot. That's hard for me to believe, and I hope I'm wrong. I hope that rates go up, because this first time they raise rates, and if they go a second time and raise rates, Wall Street, the stock market people are going to raise holy hell, because what that's going to do is typically and historically drives the markets down, because people will flee to the rates. Maybe that'll happen, maybe not. Who knows? We're in weird times. But 8 is a lot, 7's a lot, 4 raises is a lot. But I hope that they do that. I think they need to do that because we've printed so much money. Now, the question is, how does that affect annuities? And, if you're one of those people out there, I hate all annuities, Dan, then that's crazy, okay? Because there's many different types. So let's kind of go through the types. For MIGAs, the CD type annuities, and with all of this, you can go to my site and run quotes on all this, see live MIGA feeds, etc. at theannuityman.com. You know that. But MIGAs are going to be affected if interest rates move up. Now, we have already seen at the time of this taping, we've seen some MIGA carriers be proactive and start raising interest rates a little bit on the 3-year, 4-year, and 5-year. We've seen that, which is encouraging. So you can get some good rates. But know this, you cannot time it, ever. Don't try to time it. You're not a Svengali. You're not Michael Douglas in that movie, where he said, greed is good. No, that's not you. That's not me either. You can't time it. What we do is we'll keep the duration short, and we will ladder those MIGAs, say 2, 3, 4, 5-year ladder, so that money's coming due as they're hopefully raising rates. So MIGAs will, because that's the annuity industry's version of a CD. It's a CD type of annuity, because you put money in, you control the principal, you get an annual interest rate contractually, and at the end of the term that you determine, whether it's 2, 3, 4, 5, whatever, you can get your money back or transfer it back or roll it to another MIGA. So MIGAs are going to be affected in a positive way if interest rates move. Now, when we talk about lifetime income, we're talking about 4 primary products: single premium immediate annuities, SPIAs, deferred income annuities, DIAs, qualified longevity annuity contracts, QLACs, and then income riders that are attached to deferred policies like indexed annuities. Okay, so all 4 of those provide lifetime income. As long as you're breathing, the annuity company's on the hook to pay. And oh, by the way, the annuity industry has a monopoly on lifetime income. I have no idea why they don't promote that, but I am, thank you very much, Stan, the Annuity Man. But interest rates are going, because lifetime income with any type of lifetime income annuity type, and there's 4, is a combination of return of principal plus interest based on your life expectancy at the time you take the payment. The older you are, the higher the payment. Sounds eerily similar to Social Security, because it is, and Social Security is the best inflation annuity on the planet. So, if interest rates rise a little bit, it's going to move the needle on the lifetime income pricing, but not by a ton. Okay, I think you're more at risk for the life expectancy tables to change against you than you are huge interest rate moves. But people always say, I'm just going to wait to buy that income stream annuity when interest rates move. That's not smart. And I'm here to educate you so you won't say that, and you understand that interest rates play a secondary pricing role. Let me say it again. Interest rates play a secondary pricing role. So if we have interest rate movements, yes, it's going to move the needle a little bit. Can you time it? No. If you try to time it, then you have to factor in the payments that you miss while you're trying to time it. Bottom line, you can't time it. It is what it is. And I think if, let's just say the planets are aligned and the world is perfect and I'm singing harmonies with Olivia Newton-John. Let's just say that for a second. I don't think they're going to raise the interest rates. The Fed's going to raise them by huge amounts. I think it's going to be more like 25 basis points. In English, that's 1/4% every single time. I hope I'm wrong, but I think they're going to tiptoe through the tulips. Good song, by the way. As they try to, walk through the minefields of inflation and government nonsense and pressure from outside sources and possible war and chaos and upcoming elections. There's a lot happening. But the good news for all of you people out there that are already, taking your Social Security payments, the best inflation annuity on the planet, you're going to get an increase to those payments. I just talked to Jeff Miller, Social Security expert, that's going to be on a podcast here. In fact, he was on one recently that he said, there's going to be an increase next year as well in 2023. So you're going to get 2 inflation increases. Will it make up for the inflation? I don't know. But interest rates is one of those things where for the last 6 years, at least, every single person has said, well, interest rates have to go up, Stan. They just have to. Interest rates have to go up. We're at the lowest. We're low. I'm like, low compared to what? Jimmy Carter rates? Come on now. Low compared to what? Japan? I mean, during all of this time with interest rates, when it was at perceived low levels, whatever you think is low, the United States still had the highest 10-year Treasury equivalent rates of any industrialized country, period. No argument to that. Are they low compared to what we're used to? Yes, all of us old people out here. Could this be the new normal? Yes, it could be the new normal. And the other thing is, let's just say they raise it like they say they're going to raise it 7 or 8 times, 4, 7, 8, whatever the number is, and we get back to a 10-year Treasury at 2.5 or 3. We're back to normal, from 7 to 10 years ago, and we're kind of got back to where we feel it's normal. Okay, but what I want to tell you is, yes, annuities will be priced in your favor better if interest rates move. You'll see multi-year guarantee annuities being influenced, directly from those interest rate hikes. Remember, lifetime income annuities are primarily based on your life expectancy. Your life expectancy is if joint at the time you take the payment. Interest rates play a secondary pricing role, but it's common sense. If they go up and they go up drastically, it's going to move the needle a little bit. Now, for a product like fixed indexed annuities, buffer annuities, all of those types of annuities that are attached to a call option on an index, interest rates can be a positive on that because for example, index annuities for accumulation, one of the choices that you have is what's called a declared rate. In English, that's called a fixed rate. So instead of choosing an index option on an S&P point to point or whatever the cap spreads and participation rates are that we talk about, you could say, you know what, Stan, this year, because rates have moved, let's just do a declared rate. Back in the day, and I'm an old codger, been doing this a very, very long time, I remember when the declared rate could be 2.5 or 3%. And if that's the case on an indexed annuity, we might just take that. We've seen that happen before, and that could happen in the annuity world. One more thing, and just remember this. Annuities are commodity products. There's not the best annuity out there. We shop all carriers for the highest contractual guarantee. You can go to my site at theannuityman.com and run quotes on DS, BIAs, QLACs. You can even run income rider quotes. We're the only ones out there with a fully transparent, show the name of the company income rider quote. We're proud of that. You can go and get see our live MIGA feed and shop for the best MIGAs. And by the way, you can do all of this without someone talking to you. Okay, so it's 24/7, 365. We are the top direct-to-consumer annuity seller on the planet. But just remember that, yes, interest rates are going to be a positive. It's going to be a positive effect on annuities and the pricing of annuities. But don't try to time it. Don't try to time it. pull up the contractual guarantees, run the contractual guarantees, look at the MIGA contractual guarantees, and base your decision on the contractual guarantees. We can always ladder things to try to take advantage of any future pricing moves. But I think this is going to be a wild year. 2022, all eyes on the Fed, all eyes on Mr. Powell, and to see if he is actually autonomous and can make his own decision and pull the trigger without being bullied by anybody in the political spectrum or Wall Street. Let's hope so, because I'm pulling for all of you baby boomers out there to get a little bit higher rates. You deserve it. You've earned it. You've worked hard for it. So that's my take on interest rates. I look forward to speaking with you. If you're not on our mailing list, please get on our mailing list, because we will send you a weekly newsletter and a quarterly hard copy magazine and keep you up to speed. And we do that the weekly on the email. We also do YouTube channels. If you haven't seen my YouTube videos on Stan the Annuity Man YouTube channel, and the podcast we put out weekly, Fun with Annuities. Bottom line, we're educating you out here. I mean, this video is going to be on the YouTube channel, and it's a new one for us because we decided shooting it straight with Stan will be topical. These are things that are happening right now. These aren't general annuity questions. These are things that you need to know about now and make decisions on now. So we look forward to putting these out. This is the first one. I think I knocked it out of the park. Nod your head out there, everybody. And I'll see you next time on Shooting It Straight with Stan.